Overview of management accounting. So we are going to look at what management accounting actually entails. Under this topic, we will be looking at the nature of management accounting, objectives of a management accounting system, differences and similarities between management accounting and financial accounting, benefit of management accounting, qualities of information for management decision making, general classifications of cost, professional ethics in management accounting. Management accounting is concerned with providing information to assist management or to assist managers in making useful decisions for the business organization. Management accounting is designed to meet the information needs of internal users, which is made up of managers of the business. So the underlined word here is internal users. Internal users. Internal users. Information provided by management accounting are useful for policy formulation. They are useful for policy formulation, planning, strategic decision making, and controlling the entire operations of the organization. Information provided by management accounts are useful for what? Policy formulation, planning, strategic decision making, and controlling the entire operations of the organization. We are going to look at the objectives of a management accounting system. Management accounting system are established to achieve the following purposes and objectives. So, one, we have cost control. 2, cost reduction. 3, forecasting and planning. Then decision making. So actually, forecasting goes with what? Planning. When you don't forecast, how can you what? Plan. So actually, forecasting goes with what we call planning. Sorry. So now let us look at the definitions for each of them individually. Cost control. This involves managing costs to be within the prescribed limits. It's all about ensuring that cost of the organization does not exceed what management budgeted for. This one will be well explained in a topic known as limiting factors, whereby we have constraints that limit the activities of an organization in incurring cost. We have cost reduction. Here, management evaluates the operations of the business to identify inefficiencies in the operation so that they can be eliminated to bring down cost. Note that whereas cost control seeks to keep cost within the budgeted level, cost reduction goes beyond cost control by identifying prudent ways of carrying out the business's operations to eliminate irrelevant cost. So that is the difference between cost control and what? Cost reduction. So let us take note of the difference. So cost control, when we say cost control, it actually seeks to keep costs within the budgeted level. When we say cost reduction, and it go beyond cost control by identifying prudent ways to carrying out the business operations to eliminate irrelevant costs. Forecasting and planning. Information provided by management accounting enables managers to prepare and make plans for the future. This is seen in budget preparation and standard costing. Decision making. An effective management accounting system will enable managers to make prudent decisions that would help put the organization on the path to achieving its intended objectives. Differences between management accounting and financial accounting. These differences can be expressed in the following ways, that is the legal requirements, the generally accepted accounting principles, time di- time dimension, uses, and frequency of reporting. So now let's go through them one by one and note the differences and how they are um, expressed in the following ways. So we have legal requirement. Financial accounting is legally required because companies are mandated to prepare and publish their financial statement periodically. However, there is no obligation to publish management accounting information. Generally accepted accounting principles. Financial accounting statements must be prepared to conform with the legal requirements and generally accepted accounting principles established by the regulatory bodies such as the Financial Accounting Standard Board. In contrast, management accountants are not required to adhere to generally accepted accounting principles when providing management with information for internal purposes. Time dimension. Whereas financial accounting uses past or historical information, management accounting uses both historic, current, and information relating to the future. Frequency of reporting. Financial accounting is prepared periodically, annually, semi-annually, or quarterly. However, management accounting has no strict reporting frequency. They are prepared as and when management requests for them. Users. Whereas management accounting is prepared for internal use, financial accounting is prepared to be used by both internal and external stakeholders of the business. So now let us zoom into the benefit of management accounting. What are the benefits of management accounting? One is profitability. Second point is budget preparation. Third point is budget control. And we have determination of future costs. We also have performance appraisal and decision making. So let's go through one of them, about 5 points, then explain them. Profitability. Management accounting enables organizations to assess their profitability. Budget preparation. Here, useful information are provided to guide management in preparing budget for the period. So actually, that is why in management accounting we have something called the master budget. And with the master budget, it's a combination of all functional budgets. Budget control helps management to keep off expenditure so they can keep them within budgeted limits. Determination of future cost. It enables managers to predict what prices of goods and services will change in the future. Performance appraisal helps managers to assess the performance of employees so the designed ones can be duly rewarded. Decision making helps managers to make decisions pertaining to the following pertinent areas, and these areas are where to manufacture a product themselves or to outsource, as the make or buy decisions. Secondly, where to accept a proposal made by a customer or a supplier, accept or reject decisions, and whether to add a new product line or to eliminate a loss-making department of product, add or drop decision. And lastly, how to price the goods and services, that's the pricing decision. The following are the qualities of good management accounting information. One is reliable, should be reliable, should be relevant, it should be accurate, should be complete, and also it should be presented on time. So reliability simply means, and we should have confidence in the information being provided. We should have confidence, or management should get confidence in the information being provided. The information itself should be what? Objective and neutral. And we also have relevance. Relevance means that the information should have predictive and confirmatory value, or both. Then accuracy, we are talking about the information should practically avoid mistakes. Okay, so accuracy means that the information should practically avoid certain mistakes. It should be free from material errors. Yes. And completeness means that the information should be adequate for its intended use. Then it should be presented on time. Simply means that the information should be provided when needed by management. Okay, so we are going to look at some classifications of cost. We have opportunity cost, differential or incremental cost, relevant cost, sunk cost, product cost, period cost, fixed cost, variable cost, controllable cost, then uncontrollable cost. So let us start with opportunity cost. So opportunity cost relates to the cost of the benefit sacrificed whenever a decision or a course of action is made. So the cost of the benefit that you sacrifice whenever a decision or a course of action is made. Differential or incremental cost. This measures the difference between the cost of two different alternative cost of action. It measures the difference between the cost of two different alternative cost of action. It refers to the extent to which the cost of one activity differs from the other activity whenever a decision is to be made between or among alternatives. Relevant cost. Relevant costs are costs which change depending on the decision being made. So they are the costs which are affected by the decisions to be made in the future, or let's say these are the costs that affect management decisions in the future. The idea is that they are incurred as a result of particular decision being made. Thus, if the decision or the activity in question were to be ignored, such costs will not be incurred. So they are relevant or pertinent to the decisions of management. Sunk cost. Actually, and in costing, we note that a historical cost is an example of a sunk cost. So sunk cost refers to the cost which has already been incurred, and practically there can be nothing done about it, or future decisions cannot influence that cost, and they were incurred in the past and will therefore not have any influence on the present or future decisions. They are also known as expired costs. We also have product costs. These are costs associated to the goods that were either manufactured or purchased for resale. They refer to the total cost incurred in manufacturing or acquiring a product. And we have period costs. These are costs that are identified with a period of time in which they are incurred, rather than with goods produced or units purchased. Fixed cost. These are the costs that remain unchanged irrespective of the level of output, as we already know. And some of the examples are provided there. You can look at them: cost of equipment, building, warehouse, motor vehicle, etc. Variable cost, the cost that can change with the level of what output, or as the level of output was changes. So some of these costs are material costs. I think my pen is fading out. Okay, so yeah, so material cost, sorry. Okay, I think the pen has faded out. Okay, so we have material cost, cost of labor. Then, sorry, let me clean this side. Okay, then we have controllable cost. A cost is controllable if a responsible manager can directly control or heavily influence the level of such cost. Uncontrollable costs are cost items for which responsible managers cannot influence significantly such items of cost. Okay, so this is actually my specialized area. Actually, ICAG, whatever ICAG handouts that you will get, it stresses on the code of ethics, because we hold up to what our motto, that is integrity. So actually, this is a field of area that you study in financial reporting, financial management, and all the courses in ICAG, even in financial accounting. So let us go through this code of ethics and get to know how it affects management accountants, because as an accountant you would have to work by this code of ethics wherever you find yourself. So we have integrity, we have objectivity, we have professional competence and due care, we have confidentiality, then lastly we have professional behavior. So now let's take them one by one and explain them. So when we say um, you hold up to integrity, what do we mean by that? It means that professional accountants should be straightforward and honest in all professional and business relationships. Integrity implies not just honesty but also fair dealing and truthfulness. Objectivity. Professional accountants should not allow bias, conflict of interest, or undue influence of others to override their professional or business judgment. Professional competence and due care. Please, I want you to take note of these things: bias, conflict of interest, undue influence. Should be straightforward and honest in all what professional and business relationship. So we are looking at professional competence and due care now. Professional accountants have a duty to attain and maintain professional knowledge and skills at such a level that a client or employer receives a competent service based on current development in practice and legislation and techniques. So actually, accountants who follow trend, as the world is developing, accountants would have to follow that trend and would have to continuously develop their skills. So we call something continuous um, developments and practices. So that is continuous professional development. That's CPD. Yes. So actually, as accountants, ICAG Ghana actually organizes CPD seminars for professional accountants, so that they come and actually enhance their skills and their professional skepticisms. Confidentiality. Professional accountants must respect the confidentiality of information acquired as a result of professional and business relationships and should not disclose such information to third parties without the consent of the authorities or management. Professional behavior. Professional accountants must comply with relevant laws and regulations and should avoid any action which discredits their profession. So we have certain threats to accountants in business, and actually these threats are five. There are five threats that you also study in financial reports and ICAG level 2, and also management accounting as well. So these threats are what actually forbids us from applying the code of ethics. So that is the threat. That's the meaning of the threat. So these are five. So let's go through them. We have self-interest threat, self-review threat, advocacy threat, familiarity threat, then intimidation threat. So self-interest threat. It may occur as a result of the financial or other personal interest of an accountant or their immediate or close family members. Okay, so this actually is trying to tell us that with the self-interest rate, we have two forms. That is, you, the individual accountant, having an interest in a financial deal or having a personal interest in a business dealing, or a close family member or a close relative is also having that interest in that business that you are doing. So it will cause self-interest threat. Self-review threat. It occurs where a previous judgment or decision is reviewed by the person who made the original judgment or decision. How can you be an accountant and also be auditing the same account that you prepared? So it is not possible. That is the self-review threat. Advocacy threat. An accountant in a business may often need to promote the organization's position by providing financial information which may be false or misleading. So actually you advocate, you say you become an advocate. This actually happens when you have really worked for the business for a very long time. That is why actually auditors work for 6 years and they are being changed, because it causes this advocacy trait and also familiarity trait. Actually advocacy trait goes with familiarity trait. In audit we have something as management trait. So that one is also closely related to advocacy trait. So advocacy trait or management trait, if you see it in any other book. Familiarity trait occurs when, because of a close relationship, you see, because of, please let's take note of this. Yeah, yeah, okay. Okay, so because of a close relationship, members become too sympathetic to the interest of others. Yes. So intimidation threat occurs when an individual conduct is influenced by fear or threat. For example, from an aggressive and determination boss. So or an aggressive or determining boss. So your boss is actually intimidating. So if you I don't know if management accounts actually they provide cases, but if you see any case, I'm also teaching this in relation to financial reporting. So if you see any case whereby they say there is a junior accountant being supervised by a senior boss, which is the senior finance controller or senior accountant, you should know that actually there will be an intimidation threat here, because the senior will instruct the junior of what to be doing. Yes, please. So here is the end of the lecture, and thank you for your time. Please subscribe to this channel. Subscribe to my channel. Thank you.